9 days, that is all we have left before February 27th, and today specifically, gave us two of the most important signals I have seen in this entire setup. Not tomorrow, not next week, today. And I need to walk you through exactly what happened, why it matters, and what the next 9 days look like hour by hour, because the sequence from here is everything. Let me start with the numbers as they stand right now, because you need this foundation before anything else makes sense. COMEX registered silver inventory as of yesterday sits at 102 million ounces. March open interest is approximately 66 million ounces notional. That is roughly 73,200 contracts at 5,000 ounces each. Do that division and you get a paper to physical ratio of 359 to 1 in a single contract month. Not 2 to 1. Not marginally tight. 3.5 paper ounces claiming the same physical silver for every 1 real deliverable ounce sitting in those vaults. That number alone should have your full attention. But the two things that happened today are what made me sit down to record this immediately. This morning during the London session, roughly 6 to 10 a.m. Eastern, London silver lease rate spiked to 6.3% on 1-month borrowing. I want you to understand exactly what a lease rate is and why 6.3% is not a number you can dismiss. A lease rate is the cost to borrow physical silver from London vaults, not paper, not a futures contract, not a warehouse receipt. Actual physical metal borrowed from actual vaults at an annualized cost of 6.3%. Lease do not spike because silver is abundant. They do not spike because the physical market is relaxed and well supplied. They spike because someone, or multiple parties, desperately need physical silver right now, and there is not enough available at lower rates to meet that demand. At 6.3%, the market is screaming that physical silver is scarce and getting scarcer. That is the physical market talking. That is not a technical indicator. That is not a sentiment reading. That is the raw cost of borrowing real metal, and it just told us something critical. Now here is the paradox that should make every serious market observer sit up straight. While lease rate spiking to 6.3% this morning, confirming physical scarcity, paper silver was trading at 75 to 76 per ounce. The paper market said silver is cheap and plentiful. The physical market said silver is scarce and expensive to borrow. Both statements were made simultaneously in the same global market about the same metal. One of those statements is true. One is not, and the lease rate is the one that cannot lie, because it represents actual transactions between parties who need actual metal and vaults that either have it or don't. Then at 2 p.m. Eastern, the Federal Reserve released its COMEX minutes, and what they showed was not the unified, hawkish consensus that would have strengthened the dollar and pressured metals. What they showed was division. The key language described participants who were divided on what should happen next with monetary policy. Not unanimous in wanting to stay restrictive. Not aligned on the path forward. Divided. Some members want to move faster toward cuts. Some want to wait for more data. There is no consensus. In a normal market environment, that would be modestly bullish for gold and silver. But this landed during thin Lunar New Year liquidity, with China still closed, which amplified the move. From 4's and 938 to 4 the 993, sitting $7 from the psychologically significant 5,000 level. Silver rallied $3 from 74.40 to 77.44. Two events one morning, one afternoon, both pointing in exactly the same direction, and both of them directly connected to what happens 9 days from now. Here is the connection I want you to understand clearly, because this is the thread that runs through everything in the next 9 days. The 6.3% lease rate spike tells you that physical silver is tight right now. Not in 2 weeks, not eventually, but today. Vaults are charging 6.3% annually to lend metal because they know their inventory is limited and demand is high. The FOMC minutes showing a divided Fed tell you that the macroeconomic environment does not present a strong case for rolling out of precious metals. When the Fed is divided, there is no compelling argument for a strengthening dollar or rising real yields that would crush the bullish metals thesis. When the macro supports holding and physical is simultaneously tight, longs holding March COMEX contracts have every structural reason to stand for delivery on February 27th rather than rolling their positions to May. Physical tightness makes delivery attractive from a supply standpoint. Fed uncertainty makes delivery attractive from a macro standpoint. Today put both forces on the board at the same time, 9 days before the date when every party holding a March contract must declare their intentions. Roughly 75% of you watching right now are not subscribed. If this kind of synthesis, connecting lease rates to FOMC minutes to delivery math to a 9-day countdown, is cutting through the noise and showing you what actually matters, hit subscribe now. This channel exists for people who want the complete picture, not single data points pulled out of context. The full picture is what I am going to give you for the next 9 days. If that is valuable to you, drop OG John AG in the comments. That tells me you want more of this. Let me get back to the math. The inventory math for February 27th starts with 1 or 2 million ounces of registered silver today. The drain rate over the past several months has averaged approximately 785,000 ounces per day. 9 more days at that pace removes another 7 million ounces from the system. That puts projected registered inventory at approximately 95 million ounces on February 27th, and that is assuming the drain rate does not accelerate, which given today's 6.3% lease rate is not a safe assumption. Against that 95 million ounces, we have 366 million ounces of March open interest that must either roll to May or stand for delivery. Now let me walk you through what different delivery percentages mean for that equation, because this is where the scenario analysis lies. If 10% of openry, that is 36.66 million ounces demanded against 95 million available, ratio of 2.6 to 1, tape but manageable. COMEX handles it, inventory drops sharply but no crisis. A 20% stance for delivery, that is 73,200 against 95 million available, ratio of 1.3 to 1, that is crisis territory. COMEX is straining at the seams, lease rates spike above 10%, physical premiums explode, and the narrative changes dramatically. If 30% stands for delivery, that is 198 million ounces demanded against a projected 95 million available. The system breaks. COMEX cannot fulfill all requests from registered inventory. Rule changes get implemented. Cash settlement gets forced on some contracts. The two-tier market, where physical silver trades at a massive premium to paper, becomes the new reality. The question that determines which of those scenarios plays out is simply this: what percentage of longs will stand for delivery? And that is precisely where today's events change the calculus. The 6.3% lease rate tells industrial users that borrowing physical silver to cover their production needs is now genuinely expensive. If you need March silver for your manufacturing operation, standing for COMEX delivery at 77 an ounce is cheaper than borrowing London metal at 6.3% and hoping for lower prices later. That is a straightforward cost calculation, and it pushes industrial users toward taking delivery. The divided FOMC tells speculative longs that the macro case for holding precious metals is intact. If you bought silver as a hedge against Fed policy uncertainty, and the Fed just told you they're divided and uncertain, you do not roll to May. You hold and you take delivery. Both of today's events independently push the delivery percentage higher, not an overnight, but in a market with a 3.59 to 1 paper to physical ratio, marginal increases in delivery intentions matter enormously. Before today, I would have described the scenario probabilities roughly as follows: 40% chance of an orderly rollover where 20 to 30 million ounces stand for delivery and COMEX handles it smoothly. 35% chance of heavy delivery where 50 to 70 million ounces stand and the system strains but survives, and 25% chance of a system break where 80 million or more ounces stand and COMEX cannot fulfill all requests. After today's lease rate spike and the divided FOV minutes, I am shifting those probabilities. Orderly rollover 30%, heavy delivery 40%, system break 30%. Today made the squeeze scenarios more likely, not the comfortable scenario. That shift is meaningful, and it happened in a single trading day 9 days before first notice. Let me walk you through the scenario outcomes clearly so you understand what each one means for the price of silver. In the orderly rollover scenario, 20 to 30 million ounces stand for delivery. COMEX delivers from the projected 95 million ounce inventory. Registered drops to somewhere between 65 and 75 million ounces. Open interest rolls to May. Lease rates normalize back toward 2 to 3%. Backwardation fades. The squeeze narrative gets pushed to April or May. Silver consolidates in the 75 to 85 range. This scenario is still possible, but I now give it only 30% probability. In the heavy delivery scenario, 50 to 70 million ounces stand for delivery. COMEX strains to deliver but manages. Registered inventory drops to somewhere between 25 and 45 million ounces. Lease rates spike above 10% as the remaining inventory becomes genuinely precious. Backwardation intensifies. Silver rallies to 90 to 1 to 10 as the physical premium explodes. April and May become the critical months because the inventory problem doesn't disappear. It just gets compressed further. I now give this scenario 40% probability. In the system break scenario, 80 to 110 million ounces stand for delivery. COMEX cannot fulfill all requests from available registered inventory. Force majeure is declared on some contracts. Cash settlement is imposed. Rule changes are implemented mid-delivery cycle. The two-tier market emerges where physical silver trades at a massive and permanent premium to paper. Lease rates spike above 15%. Silver rallies above 120 as paper and physical pricing decouple. I now give this scenario 30% probability. Now let me give you the day-by-day roadmap for the next 9 days, because understanding what to watch each day and what it means for the February 27th outcome is the entire game from here. Today is confirmed. The setup is complete. We got the lease rate spike in the FOM division. Gold is at 4,993. Silver is at 77.4. The bulls have momentum going into tomorrow. Tomorrow, Thursday, February 19th. And yes, that is today for those of you watching this live. We get jobless claims data at 8:30 a.m. Eastern. This is the first real test of whether today's FOMC rally holds. If claims come in above 220,000, it confirms the labor market is softening, which validates the dovish interpretation of today's divided Fed minutes. In that scenario, gold extends to 4,000 and potentially 5,050. Silver tests 778 to 79, and delivery pressure builds because the macro case for holding gets stronger. If claims come in below 210,000, it rejects today's. The labor market looks fine. The Fed can stay restrictive longer. Gold pulls back toward 4,920 to 4,950. Silver tests to 76, and delivery pressure eases marginally because longs lose some of their macro confidence. Also tomorrow, Singapore reopens after Lunar New Year. This is the first Asian market feedback we get since Monday. Singapore's reaction to today's move sets the tone for Hong Kong's return on Friday. Watch what Singapore does Thursday morning their time, which is Thursday evening US time, because it tells you whether Asian buyers are going to validate or reject this rally. Friday, February 20th carries 3 major events that could each move the market independently. First, we get Q4 GP second estimate and February PMI data for both manufacturing and services. If GDP is revised lower from the initial estimate and PMI disappoints, the dovish case strengthens, metals extend higher, and delivery pressure builds. If GDP holds firm and PMI beats expectations, The hawkish case reasserts itself and metals pull back. Second, and critically, Hong Kong reopens. Hong Kong is the first major Asian gold and silver market to return after 8 days closed for Lunar New Year. They left on February 13th with gold around 40 and silver near 78. They're coming back to gold for their 993 and silver at 77, almost exactly where they left, but after enormous volatility in between, including the crash and the recovery. The question is whether Hong Kong reads the current price as a stable level and resumes buying, or whether they read the recent volatility as a reason for caution and wait for further weakness. Hong Kong's action on Friday morning their time, which is Thursday evening to Friday morning US time, tells you what mainland China will do when it returns on Tuesday. Third event Friday is PCE inflation data. The Fed's preferred inflation gauge also at 8:30 am Eastern. If PCE comes in hot, it validates the cautious wing of the divided Fed. If PCE comes in cool, it validates the dovish interpretation of today's minutes. Friday morning is data loaded and every release matters. The weekend of February 22nd and 23rd the markets are closed but positioning decisions are being made. China is still closed through Monday the 23rd. This is when institutional money makes its final decisions before China's return Tuesday. If gold closes above 5,000 on Friday, expect profit taking pressure over the weekend. If gold closes below 4,980, expect institutional accumulation over the weekend in preparation for Tuesday. Monday the 23rd is light volume globally. Hong Kong and Singapore are open, providing some Asian price discovery, but the real action waits for Tuesday. Tuesday, February 24th is, in my opinion, the single most important day of this entire 9-day countdown. Mainland China returns, the Shanghai Stock Exchange, the Shanghai Gold Exchange, and the Shanghai Futures Exchange all reopen after 8 full trading days closed. China is the world's largest gold consumer and the world's largest silver consumer. When they come back, their first bid or offer sets the direction. If China returns and immediately resumes buying gold and silver at current prices, it validates the entire bullish case. Delivery pressure intensifies. Lease rates spike higher. Backwardation strengthens. The February 27th delivery demand number starts looking dangerous for COMEX. If China returns and sells into strength or sits on the sidelines waiting for lower prices, it gives the bears breathing room, delivery pressure eases, and lease rates could normalize. I cannot tell you which China will show up on Tuesday, and anyone who claims they can is lying to you. But I can tell you that if gold is sitting above 5,050 when China returns, they are more likely to wait. If gold is near 4,900 and silver is near 74, China buys aggressively. That price relationship on Tuesday morning matters more than any single data point between now and then. Wednesday, February 25th, 2 days before first notice, is when the open interest data becomes the central focus. How many March contracts are still open? Have longs been rolling to May over the past several days? Or are they holding for March delivery? Wednesday's open interest report tells us the Friday delivery demand before it happens. If open interest has dropped sharply from 366 million ounces to somewhere around 250 million ounces, orderly rollover is in progress, delivery pressure is easing and the squeeze gets pushed to a later month. If open interest is still above 300 million ounces, heavy delivery is in play. If open interest is still near the current 366 million ounce level, the system break scenario is live. Wednesday's open interest number is the last clean warning before the storm. Thursday, February 26th, 1 day before first notice, is historically the highest volume day of the entire delivery cycle. This is the last day for longs who held all the way to the wire to make their final decision, stand for delivery or roll to May. This is also the day shorts who do not want to deliver must cover their positions or roll. Expect a large price moves in both directions. Expect open interest to change dramatically in the final 24 hours before first notice. Anything can happen on the Thursday before first notice, and whatever happens will set the emotional and technical tone for Friday. Friday, February 27th. That is the day. March first notice day. The day that everything we have been watching, measuring, calculating, and analyzing comes to resolution. The standing delivery data gets published. We find out exactly how many ounces were demanded for March delivery against the inventory COMEX has available. COMEX either delivers physical metal from whatever registered inventory remains at that point, or it cash settles positions it cannot fulfill, or it changes the rules. And every one of those outcomes tells us something definitive about the state of the silver market. This is when the thesis gets tested in public, in real numbers on the record. Let me close by explaining exactly who is borrowing silver at 6.3% this morning and why each of those parties is a bullish signal for February 27th. There are 3 groups who borrow silver at these rates like this. The first group is shorts who are short March contracts and need to deliver silver. They either buy silver outright in the market to deliver, or they borrow it from London vaults to fulfill their delivery obligation and hope to buy it back cheaper later to return it. At 6.3% borrowing cost, borrowing is genuinely expensive. The rational trade for many of these shorts is to simply cover, buy back their short position and exit, rather than pay 6.3% to borrow metal and hope for a cheaper buyback. When shorts cover, that removes selling pressure from the market. That is bullish. The second group is industrial users who need March delivery for their production schedules, but prefer not to take COMEX delivery. They would rather borrow London silver for immediate use and let their COMEX contracts roll to May. But at 6.3% borrowing cost, that calculation changes. At that rate, it may be cheaper and more straightforward to simply take COMEX delivery instead of paying 6.3% on borrowed London metal. That means more delivery demand on February 27th. That is bullish. The third group is arbitrageurs who are exploiting the backwardation between London spot prices and COMEX futures prices. They borrow London silver at 6.3%, ship it to New York, deliver it against COMEX contracts at higher prices, and pocket this 0.3% plus shipping plus insurance plus the cost of capital erodes the arbitrage profit significantly. The fact that people are still paying 6.3% to execute this trade tells you that the backwardation between London spot and COMEX futures is wide enough to make it worth doing even at that cost. That confirms that backwardation is real, significant, and not a temporary anomaly. All three of those use cases, shorts covering industrial users taking COMEX delivery, arbitrageurs confirming backwardation, are bullish for March 1st notice. Today's lease rate spike did not happen in a vacuum. It happened 9 days before the most important delivery deadline in recent silver market history, and it is telling you the physical market is under genuine stress. Here is exactly what I am watching every single day between now and February 27th. The daily COMEX inventory report published at 2 p.m. Eastern tells us the registered and eligible ounce counts. If registered containing at 785,000 ounces per day, we hit February 27th near 95 million ounces. If that drain rate accelerates to 1 million ounces per day, which today's lease rate spike makes possible, we hit first notice with under 90 million ounces, and the math gets significantly more dangerous. Open interest data published daily tells us whether longs are rolling to May or holding for March. If March open interest starts dropping sharply before the 26th, orderly rollover is happening. If it stays elevated through the 26th, heavy delivery or system break is in play. Lease rates, which I am watching continuously. If they stay at 6.3%, that is sustained confirmation of physical tightness. If they spike to 8% or 10% over the next week, the physical squeeze is intensifying in real time. If they normalize back toward 3%, physical pressure is easing and the immediate squeeze thesis weakens. The backwardation spread between London spot and COMEX futures. If that spread widens, physical premium is growing and the squeeze intensifies. If it narrows or flips to contango, physical pressure is easing. The dollar in yields is macro context. DXY currently at 97.20, and if it strengthens above 97, that is a headwind for metals. If it weakens below 97, that is a tailwind. 10 yields at 4.87%, above 4.5% is a headwind, below 4% is a tailwind. And above all of those, China on Tuesday, February 24th. Do they buy or do they sell? Because that single question may determine whether we get scenario 1, 2, or 3 on February 27th. Let me be direct with you about what I do not know, because I think that honesty is what makes this analysis worth your time. I do not know which scenario plays out. Nobody does. The orderly rollover is still a 30% probability. March delivery could come in at 25 to 30 million ounces. COMEX could handle it smoothly. Lease rates could normalize. Backwardation could fade, and open interest could roll to May. The squeeze could get pushed to April or May, when inventory will be even tighter and the structural imbalance will be even more pronounced. That scenario is real and possible. What I can tell you is what I saw today. And today I saw lease rates spike to 6.3%, confirming physical shortage, while paper traded at 75. I saw FOMC minutes show division confirming macro uncertainty that supports holding precious metals. I saw gold rally 55 to 49.93. I saw silver rally $3 to 77.44. And I saw both of those moves increase the probability that longs hold for March delivery instead of rolling, which shifts my scenario probabilities toward the heavy delivery and system break outcomes. The math is 1.2 million ounces of registered silver against 3.66 million ounces of open interest. The ratio is 3.59 to 1. The lease rates are 6.3%. The backwardation is confirmed. The Fed is divided. China returns Tuesday. Hong Kong returns Friday. And first notice is 9 days away on February 27th. That is the convergence. Physical shortage confirmed through lease rates. Macro support through divided Fed. Technical setup with gold sitting at $4,993, $7 from 5,000. And a calendar counting down to the day we find out whether the paper market can actually deliver the physical metal it has promised. Physical will win. The only question is when, and whether February 27th is the day it becomes undeniable or whether it gets pushed to April. Today's lease rate spike and divided FOMC minutes tell you that the probability of March being the month just went up. Do your own due diligence. Use your own brain. Don't follow anyone blindly, including me. Understand the risks, understand the scenarios, and watch the numbers every single day for the next 9 days. 9 days. OG out.